The most dangerous trade doesn't happen during confidence. It happens right after a loss. The screen is still open, the chart hasn't changed, but something inside you has. The loss feels recent. It feels unfinished. And unfinished feels uncomfortable. You don't just see red numbers. You feel interruption, a plan disrupted, a prediction denied, an outcome that should have worked. In that moment, the market stops being neutral. It feels personal, not because it is, but because your expectation collided with reality. And when expectation breaks, the mind wants repair. It wants balance restored. That's when revenge trading begins. Not loudly, not dramatically, but quietly, as a subtle urge to enter again, not because the setup improved, but because the loss still feels open. Revenge trading doesn't start with anger. It starts with discomfort and the desire to make the discomfort disappear. In that space after a loss, the mind searches for relief, not strategy. Relief. It wants the chart to cooperate. It wants the next candle to agree. It wants proof that you were right. This is where emotion disguises itself as logic. You tell yourself the setup still makes sense. You convince yourself the market overreacted, but the urgency you feel is not analysis, it's tension. And tension wants action. That is the true beginning of revenge trading. Losses are not just financial, they are psychological. When you take a trade, you don't just risk capital, you risk belief. You believe your analysis makes sense. You believe your timing is reasonable. You believe you understand what is happening. When the trade fails, that belief fractures, and the brain doesn't like fractured beliefs. It prefers consistency. It prefers being right. So when the market moves against you, it doesn't feel random. It feels corrective, as if the market rejected you, even though it didn't. This is why losses feel personal. They interrupt your internal narrative. You had a story about what would happen. The market wrote a different one. And when your story collapses, you feel exposed. You feel challenged. You feel wrong. That discomfort is subtle but powerful because it creates a need to restore identity, to prove the analysis was valid, to prove the mistake was temporary. Revenge trading feeds on that need. It promises emotional repair, one more trade, one quick recovery, one correction. But what you're really chasing is not money, it's validation. This is where ego quietly enters the equation, not in an obvious way, but in subtle resistance. You don't want to accept that the market invalidated your idea, so you reinterpret it. You search for confirmation. You zoom into smaller time frames. You find new reasons. You adjust the narrative, all to protect the original belief. But protection is not objectivity, it is attachment. And attachment makes the next trade less about probability and more about self-defense. That's why losses feel heavier than their size suggests, because they threaten identity. And identity, once threatened, wants restoration, even at a cost. After a loss, the urge doesn't feel reckless. It feels corrective. You don't think, I want revenge. You think, I just need to fix this. That small shift in language changes everything because fixing feels responsible. It feels disciplined. It feels like staying engaged. You convince yourself that one clean trade can restore balance, that one accurate entry can erase the discomfort. And technically, it can. That's what makes it dangerous, because sometimes you do win it back. And when you do, the brain links relief to immediate action. Loss, trade again, relief. That loop installs quickly. The problem isn't only the loss, It's the speed of response. You shorten the distance between emotion and execution. And when that distance shrinks, discipline disappears. You start trading to regulate feeling, not to execute strategy. The chart becomes secondary. The account becomes secondary. The emotional state becomes primary. That's when revenge trading moves from impulse to pattern, and patterns are harder to stop than impulses. The urgency feels rational. You tell yourself that acting quickly prevents bigger damage, that staying passive makes things worse. But urgency is not clarity, it is discomfort looking for movement. You start scanning the chart for any reason to enter, not the best setup, any setup. You lower your standards slightly, then slightly again. You increase size just enough to matter. You shorten your stop. You aim for faster outcomes. Because speed feels like control, but speed is rarely precision. And when you mix emotion with acceleration, mistakes compound. The second trade is rarely independent from the first. It carries its weight, its frustration, its unfinished tension. That is why revenge trading is not just about recovery. It is about emotional continuity. And emotional continuity is what turns one loss into a spiral. Revenge trading doesn't remove logic instantly. It distorts it. You still believe you are thinking clearly. You still analyze levels. You still look at structure. You still speak in rational terms. But the foundation has shifted. Before the loss, you were evaluating probability. After the loss, you are evaluating possibility. Probability asks, what is likely? Possibility asks, what if this works? That subtle shift is where discipline weakens. You begin to justify entries that would normally fail your criteria. You widen acceptable zones. You reinterpret signals. You move from precision to persuasion. And persuasion is emotional, because now you are trying to convince yourself, not measure risk. You ignore position sizing rules. You increase exposure just enough to feel impact. You shorten your time horizon. You want resolution, not structure. And when resolution becomes the goal, analysis becomes decoration. It looks rational. It sounds technical. But underneath, it is urgency wearing logic as a mask. That is how logic disappears, not by leaving the room, but by being replaced without you noticing. The most dangerous part is that it still feels intelligent. You can explain the trade, you can defend the entry, you can build a convincing case for why this time is different. And that's what makes it hard to detect, because from the outside, nothing looks chaotic. The charts are open, the indicators are aligned, the reasoning sounds structured, but inside, the motivation has shifted. You are not asking whether the trade fits your system. You are asking whether it fits your need for balance, your need for correction, your need for relief. And when need replaces criteria, logic becomes flexible. Flexible logic is emotional logic. It adapts to justify action. And the more it adapts, the further you move from disciplined execution. That is how revenge trading hides in plain sight. Revenge trading rarely stays small, it escalates. The first trade after a loss is usually controlled. Position size feels normal. Risk feels measured. But when that trade doesn't resolve the discomfort, the pressure builds. You don't want another loss. You want closure. So you adjust, you increase size slightly, you move stops closer, you aim for faster targets. Each adjustment feels logical in isolation, but together they form a pattern of acceleration, loss, action, adjustment, and every cycle tightens emotional pressure. You start monitoring every tick, every candle matters, Every movement feels personal. And when the market moves against you again, the escalation continues. You trade more, you trade bigger, you trade faster, not because your strategy improved, but because your emotional tolerance shrank. This is the escalation pattern. It doesn't explode immediately. It compresses. It narrows your thinking. It removes flexibility until one trade carries more weight than your system was designed to handle. And by then, the damage is no longer psychological. It's structural. What makes escalation dangerous is how gradual it feels. You don't wake up planning to double your size. You slide into it, one small increase after another, each justified, each explained. You tell yourself that you're adapting, that you're adjusting to market conditions, but the adjustment is emotional, not technical. You begin chasing volatility. You prefer fast movement because slow markets don't give quick resolution. You shorten patience. You widen risk tolerance. And when the market resists you again, frustration intensifies. At this stage, you are no longer trading a system. You are trading a feeling that demands relief. And relief in markets is expensive because escalation doesn't end with recovery. It ends with exhaustion or with damage that forces you to stop. Professional traders experience losses too. The difference is what they do immediately after. They don't try to erase the loss. They create distance from it. After a losing trade, they step away, not dramatically, not emotionally, but deliberately. They allow the nervous system to settle because they understand that the next decision is never independent. If emotion is elevated, execution is compromised. Professionals also predefine limits. If they hit a daily loss threshold, they stop. No negotiation, no second chance, no emotional exception. They know that the first trade after a loss is statistically weaker, not because the market changed, but because they did. They protect structure more than they protect ego, and structure requires separation. Separation between loss and action, separation between discomfort and response. That separation is what prevents escalation. It turns a loss into information instead of a trigger. This discipline is not based on willpower. It is based on rules. Professionals don't trust themselves in emotionally charged moments. They assume bias. They assume distortion. So they design systems that override impulse. Some step away for a fixed amount of time. Some reduce size automatically. Some close the platform entirely. Not because they are weak, but because they understand how quickly emotion compounds. They don't try to prove strength by taking another trade. They prove discipline by refusing one. And that refusal protects long-term consistency, because the goal is not to win back a loss. It is to preserve the edge that makes winning possible over time. Tick zero is not before every trade. It is most powerful after a loss. The chart is still open, the emotion is still active, and the urge to act feels justified. At tick zero, the question is simple. Not whether the setup exists, not whether the analysis is sound, but whether the trade is coming from structure or from discomfort. That distinction is everything, because revenge trading doesn't announce itself. It feels strategic, it feels corrective, it feels necessary. Tick zero interrupts that feeling. It forces a pause, a separation between loss and response. If you cannot wait 5 minutes, you should not trade. If the urge feels urgent, you should step away. That moment of refusal is not weakness, it is strength, because every time you respect tick zero after a loss, you protect your future decisions from your current emotion. And that is how discipline survives volatility. The hardest part of tick zero is not understanding it, it is respecting it, because after a loss, doing nothing feels wrong. It feels passive, it feels like giving up control. But discipline is not about reacting faster, it is about choosing when not to react at all. And every time you step away, instead of trading immediately, you weaken the pattern that revenge trading depends on. That pause is where long term consistency begins.